Okay, so guys, we're going to go through another problem as it relates to taking transactions. Remember, transactions are those items that will record economic events. And so while there are many activities, not all activities will necessarily become transactions that are reported or recorded. So when someone makes a commitment to do business in the future, unless there's money or some type of legal contract that involves cash that's been transmitted up front, even though that's an activity, it is not necessarily an event that is recorded. So we're going to take a look at these in E3.6, various transactions, and talk about what is the accounts that are involved, and do they go up and do they go down. Now, just for just a little bit of information to remind you, when we are dealing with transactions such as debits and credits, we're going to remember something. I'm going to put this microphone down so I can type. But remember that when we're dealing with an account, let's just say this is a cash account. This cash account is an asset. And we can take a cash account, which is an asset, or we can choose to take various types of assets, be it, excuse me here. Let's just assume we're dealing with, in this case, cash, or we can have accounts receivable, we could have equipment, we could have a patent. All of these are assets, and an asset has a normal debit balance. All that means is the left side of the equation is the normal balance. And so when we increase our cash, or we increase accounts receivable or equipment or patents, any assets, when we increase them, we're going to debit that for an increase in an asset. We will credit it, which means the right side of the T account will credit it to reduce an asset. This is what we do for all assets. We debit to increase, we credit to decrease. Now, if we think of the equation, assets equal liabilities plus owner's equities, the asset side is going to be a debit is the normal balance. And on the other side of the equation, the liabilities and the owner's equity, the normal balance is a credit. Now, that doesn't mean that we don't credit assets and we don't debit liabilities, but the normal balances for assets would be a debit, and the normal balance for liabilities and owner's equity will be a credit, okay? This is just a really important concept to grasp. Now, in the same respect that we're talking about assets here, the other thing that I want to do is let's take a look at liabilities. A liability has a normal credit balance. So when we're dealing with liabilities, now, liabilities such as accounts payable, such as notes payable, such as bonds payable, or mortgages payable. The normal balance in a liability is the credit side, which means the right-hand side. And so with a liability, you're going to credit it, which means enter the number on the right-hand side for a normal balance. And then to reduce a liability, we're going to debit it. It's the exact opposite of an asset. With an asset, to increase, we're going to debit it. To decrease, we'll credit. With a liability, it's the opposite. To increase, we will credit. To decrease, we will debit. The same is true for stockholders' equity. If we go down and we show with stockholders' equity, let's show this as common stock, and let's show this as retained earnings. In the stockholders' equity section, to increase stockholders' equity, we'll credit this. And to decrease stockholders' equity, we will debit it. So remember that accounting equation: assets equal liabilities plus owner's equity. The asset side of the equation will always have a normal debit balance, which means left. The liabilities and owner's equity will always have a credit balance, which just means right. So this is really an important concept to focus on as we move forward in this book. And what we'll do is we'll go through problem after problem just so you can understand this. So if we look at the issued stock to investors for $15,000 in cash, what accounts are we dealing with when we talk about cash and stock? Well, we're dealing with the cash account, which is an asset. We're dealing with stock, which would be a stockholders' equity section. And cash is an asset. So when we increase an asset, we're going to debit that asset. When we increase stockholders' equity or common stock, we're going to increase it by crediting it. So in this particular example, E361, we will increase our cash and we will increase our stockholders' equity. So if you think about it, if we had an account that was cash here, we're going to increase it by $15,000. And our stockholders' equity, or our common stock down here, we would increase it, which means credit that common stock account. In the same respect, let's look at purchased used car for $10,000 cash for use in business. What's going to happen here? We're dealing with cash, and it's going to go down, and we're dealing with a fixed asset, an automobile, which is an asset that will go up. So what will happen is one asset is going to go down and one asset is going to go up. So in cash, we would be crediting this cash. I forget, was it $10,000? Yes. So we would credit this $10,000 for cash, credit it, reduce it, and we're going to show this as auto, which is an asset here, and we would debit that auto or increase it by $10,000. So as you can see here, we have a debit and we have a credit. Our cash went down, so we credited it. Our automobile went up. It increased, so we debited that. Both are assets in that scenario. Next, we purchased supplies on account for $300. When we know the term account, that means we didn't pay cash for it up front. So basically what we did there is we have an accounts payable, which is a liability. So that liability is going to be increased. And our supplies account, which is an asset, is going to also be increased. So if we can look and fill that out, we have accounts payable that is increased for $300. And then we also have something called supplies, which is an asset. And that asset is increased by $300. So again, the liability was increased by a credit. The supplies was increased by a debit. Again, the debits and the credits always need to equal. And in this case, we have a debit in supplies, which increased our supplies. We have a credit in our liability, which increased our accounts payable or our liability. Next, we billed customers $3,700 for services performed. Billed customers for services performed. That sounds like a revenue. Now, for this purpose, we can do a revenue account or a sales revenue. And since we billed customers, we didn't receive the cash up front, we are going to have an accounts receivable there. So for purposes right now, we know a revenue account ultimately flows over into retained earnings. We would be clicking on the revenue, which would increase, but for purposes of ultimately how it plays out here, our retained earnings is going to increase. So our retained earnings will go up $3,700. It's being increased, and we know that stockholders' equity to increase is a credit balance. Likewise, we didn't receive the cash, it's on account, and so our accounts receivable will be increased $3,700. That again is an asset. When we increase an asset, we debit that asset. Again, debits always equal credits in this scenario. The next, we paid $200 cash for advertising start of the business. We paid $200 cash. That means cash is decreased or credited. It goes down $200. Now we know that that's an expense, but it's always going to play out with our retained earnings. So when we decrease retained earnings, because we're spending $200 that the stockholders are not going to end up getting, so we are going to decrease our retained earnings by $200, which is a debit. Again, the normal balance of retained earnings is a credit balance when we increase it. But when we take away, we're going to debit our retained earnings. Now next, we've received $1,100 cash from customers billed in the transaction 4. In 4, we see we billed customers $3,700 for services performed. Now we received that $3,700 that's in accounts receivable. $1,100 of that money's come in. So what happens here is $1,100 cash has come in, which means our cash has gone up or increased $1,100, which is an increase as a debit account. Now, our accounts receivable, which is an asset, is going down $1,100, which means we're going to credit that accounts receivable for $1,100. In this scenario, both accounts we're dealing with are assets. Cash and accounts receivable are both assets, but our cash is increasing. Our accounts receivable is decreasing since we've received that money in. So our cash will be debited since it's increasing, and it's a normal debit balance for assets. And our accounts receivable is decreasing, so we'll be crediting that, which is, since it's got a normal debit balance when it increases, we'll credit that accounts receivable. Next, paid creditor $300 cash on account. Do you remember up here in 3, we purchased supplies on account for $300. Now we're paying off what we owe. So do you see here how we credited our $300, because we have a liability here. We're going to pay that liability. So if a liability has a normal credit balance, we're going to debit that liability to reduce that liability. So we'll debit it, but then also remember, with our cash, we're using up cash, so we're decreasing our cash, which means we're going to credit our cash. Again, it's important to know that debits need to always equal credits in every transaction that we perform here. Next, we pay dividends of $400 cash to stockholders. So again, when we pay cash, we're reducing our cash. If our cash has a normal debit balance, by using cash, we're crediting our cash for $400. And we're also paying out dividends, so we're reducing our retained earnings of $400, which means we're debiting that $400. Again, remember, and it's always helpful to have a little